If you are exploring foundation structures to protect your assets, plan for succession, or manage global wealth, Switzerland and Dubai are two of the top options. Switzerland offers long-standing tradition and prestige. Dubai offers speed, control, and flexibility. So in this video, we'll break down the key differences from setup, banking, and tax treatment to control, privacy, and long-term use of a Swiss foundation versus a Dubai foundation, so you can decide which one suits your needs the best. In today's global environment, asset protection isn't just about hiding wealth. It's about compliance, control, and legacy. Swiss foundations appeal to families with deep European ties or philanthropic objectives. Dubai foundations, especially within the DIFC, attracts business owners, international families, and mobile professionals looking for flexible, bankable, and tax-aware structure. A Swiss foundation is typically a not-for-profit entity. It's designed to hold assets and apply them towards a specific purpose, which may be charitable, family-related, or institutional. The key point is that it must serve a purpose outside the founder's personal interest. Once established, the founder gives up the ownership and a foundation board takes over. Swiss foundations are regulated under civil law and have a long-standing reputation for stability and seriousness. Dubai foundations, especially in DIFC and adgm, operates under the English common law principles. These are private asset holding vehicles with a founder, a council, and a defined set of beneficiaries. Unlike in Switzerland, the founder can retain significant control. The foundation doesn't need to be charitable and can be entirely private. You can even be the founder and one of the beneficiaries. That makes Dubai Foundation especially attractive for estate planning, succession, and intergenerational wealth management. Now let's consider setup and flexibility. In Switzerland, establishing a foundation requires approval from a supervisory authority. The founder must start the foundation with a minimum amount, often starting from 50,000 Swiss franc or more, and provide a founding charter. Once the foundation is established, the founder has no ongoing influence unless expressly retained through the governance role. Changing the foundation's objectives later is difficult and requires regulatory approval. In Dubai, the process is far streamlined. Foundations can be established within days and with minimal bureaucracy. DIFC and adgm both allows 100% foreign ownership, and there is no requirement for a local sponsor or service agent. You can customize the charter, retain powers as founder, and amend the structure as your family business evolves. This makes Dubai a dynamic option for clients who value privacy, control, but also adaptability. Banking is where the contrast becomes even sharper. Swiss foundations are historically associated with private banking. However, modern compliance standards mean opening a bank account is no longer automatic. The foundations must demonstrate a real purpose, full documentation, and a transparent source of funds. Many Swiss banks are cautious with passive foundations, particularly those tied to non-resident founders. In Dubai, foundations are increasingly bankable, especially with the right structuring and purpose. DIFC foundations in particular are accepted by major banks in the region and even internationally. If the foundation is used for legitimate succession or business structuring purposes and supported by solid documentation, it can function as an operational holding or investment vehicle. Dubai's strong KYC framework helps foundations maintain credibility without sacrificing flexibility. When it comes to privacy, both jurisdictions score well, but in different ways. Swiss foundation offers confidentiality through tradition. However, global reporting standards like CRS and FATCA have reduced the secrecy once associated with Switzerland. Today, discussion comes from lawful transparency, not anonymity. Dubai foundations, meanwhile, benefits from private registers. Your name as founder does not appear in public database. The foundation charter is not published, and beneficiaries remain confidential. Yet, the structure remains fully compliant with international standards, including CRS and FATCA where applicable. So you get privacy without the exposure of risk. Let's also address the tax treatment. Swiss foundations may benefit from tax exemptions if they are charitable, but private family foundations are typically taxed on income and gains with limited deductions. You also have to consider wealth taxes and succession rules depending on the canton. Dubai foundations, on the other hand, are not subject to income tax, capital gains tax, or withholding tax. Even with the introduction of corporate tax in 2024, most holding and family structures remain outside its scope. This gives a clear advantage for clients looking to preserve wealth and avoid tax leakage, especially when paired with careful cross-border planning. Now, control and succession are at the heart of every foundation structure. In Switzerland, once the assets are transferred, the founder loses control. The foundation is managed by a board, and decisions must align with the defined purpose. For philanthropic purposes, this works very well. But if you're looking to guide or adapt the foundation over time, Switzerland may feel rigid. In Dubai, the founder can retain powers, including the right to appoint or remove council members, amend the charter, or even revoke the foundation under certain terms. You can also combine the foundation with other structures like SPV, trust, and holding companies to build a tailored ecosystem. For international families with assets in multiple jurisdictions, this kind of layering can be very strategic. Now, let's put this into context with two client types. A European family with long-standing philanthropic goals, strong ties to Switzerland, and no desire to remain involved post-establishment. A foundation is often ideal, but a global entrepreneur based in London with real estate in Dubai, operating companies in Asia, and children, let's say in the US, the Dubai Foundation offers unmatched control, tax neutrality, and international usability. Both jurisdictions have substance requirements, but Dubai has a clear edge in flexibility. You don't need local directors or expensive ongoing audits. Annual filings are minimal, and there is room to scale. You can start with a simple family charter and grow the structure over time. That said, Switzerland still holds immense prestige. A Swiss foundation sends a message of seriousness, often useful in institutional or philanthropic settings. If your structure will be reviewed by regulators, grant committees, or larger banks, Swiss Foundation may carry more weight. Ultimately, the choice depends on your objectives. If you want permanence, governance, and European alignment, Switzerland makes sense. But if you're seeking control, speed, and global relevance with full compliance, Dubai is extremely attractive. If you own a business or real estate, don't wait for legal or health crisis to start thinking about protecting your wealth. Many people think asset protection is only for ultra wealthy. But the reality is that some of these solutions cost as much as setting up a free zone company in Dubai. If you want to secure what you have built and ensure your legacy, you can request your free and customized asset protection plan by clicking the link in the description below. And if you're serious about building long-term financial security, you should really check out my next video right here.